Hi ladies and gentlemen, this is Game of Trades and this is going to be a technical analysis of the S&P 500 index. I'm going to cover what's to be expected in the week to come. We're Sunday, so what to expect when the market opens and within the next few weeks as well, what I think will happen in the markets. Make sure to like and subscribe if you haven't already. It helps me out a lot. Anyways, let's get right into it. This is a daily chart of the S&P 500. Each candle is a day. You can see we have a huge rally off of the 2018 lows here. Really overextended. You can see we're overbought in the RSI with no major pullbacks along the way. We did have one small pullback here, but nothing significant. We didn't even retrace one Fibonacci level, I think. We can take a look at the Fibonacci levels off of the bottom here. We didn't even reach the 23 level. So this can't really be considered as a real healthy pullback along the way. This has just been nonstop grinding up. So no real buying opportunities since around here. If you were long, nobody's buying here. There's no way to swing trade this. We are at resistance, nearing a double top. So anyone who's investing in the S&P 500 right now is absolutely crazy. I think the volume isn't here, but I know the volume is tapering off, which is usually not a very good sign when we're grinding up. So if there's a trade to make, it's a short trade, especially considering we have a divergence here on the daily chart. What does this mean? This means a trend change is likely. It means we're likely to see downside in the coming days, especially off of overbought levels, and especially after such an overextended rally, and only makes sense, and also at resistance at all-time highs. Now I think we may get a marginal new high. If you didn't watch my last video on the stock market crash thesis, I pointed negative divergence on the weekly chart, which is a very bad sign and could potentially lead to a lot lower sides. But for now, I'm going to keep this video very factual and assume that we're going to continue the uptrend because it's the safest bet right now. I do think there is a chance that we'll see a lot further downside in 2019. That is certainly a possibility, but for now, I'm just gonna stay reasonable and look for a healthy pullback back to some Fibonacci levels, back to some actual levels, and I'm gonna show you these levels that I'm looking at. All right. So of the lows, the Fibonacci retracement levels are here, and these coincide perfectly well with some of the actual levels that are here. You can see this 282 level that we watched a while as we were approaching this resistance. You can see we have a sort of a triple top pattern here, 3 fails at resistance, another fail here, and then we burnt through it. If we do start pulling back, I'd suggest having this first buy opportunity here. Second along the way is halfway through this range. There's a range here between 282 and 263, and there's a point halfway along the range where you could see another stop, and this last level here, right here. These are approximate levels. but they do again coincide with the Fibonacci retracements level. So you get a press level and the Fibonacci level right under, right above it. And I'm looking for a pullback to any of these uh, three support levels. And I think it will happen. I think it'll happen in the coming weeks. And if we start obviously breaking these support levels, then we'll start seeing more downside in the future, potentially seeing those weekly bearish divergence that I talked about in my last video. Make sure to watch that video if you haven't already. Those weekly divergence may play out if we start breaking these levels. So for now, look for a pullback to one of these, and potentially, a short trade here. You can start shorting the markets. I do have a small short position right now here at this market top, and I'll continue to add as we, continue grinding up with no correction. I'm waiting for somewhat of a correction. This cannot go on forever. And in the worst case scenario for the bears, and I know there's lots of arguments going around, people saying that analysts are too bearish, that uh, the markets don't always need to correct. Well, that's not true. With MACD divergence, you very often get a backtest of the zero line. You can see that happened right here. We had a backtest of the zero line. Right here, backtest of the zero line. We had one here. It works in both ways. The zero line acts as a support and resistance. Again, here we had a resistance at the zero line, and then we burned through it, backtested it, and this hasn't happened for a while. We haven't backtested the zero line for a long time, and that is why I'm expecting that. Not only do we have divergence signaling a correction, but we haven't backtested the zero line, and I think the best case scenario for the bulls is that the MACD starts to turn down and start turning back up at the zero line, and that would potentially, potentially look something like this, perhaps. And that's what we had in 2017, where we didn't really have a correction of the divergence, but you did have the markets have a sort of sideways training range for a few weeks before they started breaking out um, to all-time highs again. So it doesn't need to be impulsive. Divergence don't always play out for very impulsive trades, but what I usually say is that the steeper the rally, the steeper the correction. And you can see that was the case here when we had a huge steep correction. We had a V-shaped rally at the end. You can see again here we had huge bullish rally here in the beginning of 2018, and then a huge correction right after. That's what tends to happen with these big moves. You have a big steep move from one side, prices swing too far to one side, and you get a correction the other way. That is what healthy markets look like, and that's what healthy markets do. But, again, uh, that is obviously my preferred scenario, not necessarily to this level, but at least to this level. But again, the markets do seem overly bullish right now, and it's certainly a possibility to see a not impulsive correction, but a timely correction. And the result would be the same. The result would be longs. If you're long in the market, you're not getting destroyed, but you're not really making money. So best to be out of the markets. And if you're short, well, you might make a little bit of profit, but nothing huge. But that's definitely something to watch out for with the MACD. watch this level, watch this zero line, watch if the MACD starts turning back up at the zero line. If that's the case, then that is extremely bullish for the future. It could mean we will rally another 10-15% up before we see another correction. And that's exactly what happened here off of this back test. People were saying, we're going to break the trend line, which we ended up doing. But we didn't break it just yet. We backtested, turned up off the zero line, and from there on we actually went ahead to make a 10% move up in the markets. It's a huge move up from that backtest. So that is definitely something to watch. In summary, divergence, correction to one of these three levels, or in the worst case or best case scenario, depending on how you see it, a timely correction for a few weeks. That's my view on it. Don't hesitate to tell me what's your take on the markets. In the meantime, good luck and see you next time.